you are lying in bed doing the math again. Not because anything went wrong, you are just in the dark, running the same numbers you ran last Sunday and the Sunday before that. Mortgage, car payment, student loan, groceries, trying to figure out if this is the month you finally get ahead, or if you are just going to tread water again like you have been for 3 years. You know the answer. But you keep running the math anyway, because the alternative is accepting that this is just what life feels like now. Meanwhile, your neighbor on the same street, bought around the same time, has a similar house, and not some wildly different income. Last Tuesday, he woke up and decided to take the week off. No crisis, no email to his manager. He just did not feel like going in. So he did not. He is not richer than you. He just stopped doing that math. Today, we are going to talk about what the personal finance world wildly underexplains. What actually happens to your money, your career, your brain, and your life the moment you make that last mortgage payment. Nobody tells you, 12 years deep into a 30-year mortgage, that you do not just lose a bill when it is paid off. You lose a prison sentence you had stopped noticing you were serving. The average monthly mortgage payment in 2025 hit $2,329. For someone at current rates, $2,845 is closer to reality. The median household takes home around $5,400 a month after taxes. That means the mortgage is consuming 43% of disposable income before a single grocery is bought. Every financial professional agrees the healthy limit is 28%. Most people carry a mortgage 15 percentage points above that limit for 30 years. Consider a household earning $110,000 a year. After taxes and deductions, they take home around $6,800 a month. Mortgage, property taxes, insurance, maintenance reserve, 2 car payments, car insurance, gas, student loans, health insurance premiums, groceries, and utilities consume nearly all of it. They are left with roughly $130. They are not irresponsible. They did everything they were supposed to do. And every financial decision they make gets filtered through one silent question. Can we still cover the mortgage? That question runs in the background like a tab they can never close. Here is what actually frees up when the mortgage is gone. Property taxes, insurance, and maintenance on a $400,000 home still cost roughly $838 a month. So if your payment was $2,845, you have freed up around $2,000 a month in real deployable money. Invested monthly in a Standard & Poor's 500 index fund at the historical average of 8% annually. 5 years gives you $146,000. 10 years, $365,000. 15 years, $693,000. And 20 years over $1,177,000. You contributed $480,000 of your own money. The market added $697,000 on top. The majority of your wealth came from compound interest, not from working harder. If your rate is below 5%, the math technically says, invest the difference rather than prepay. That argument is not wrong, but it assumes you actually invest the difference. Most people spend it. The mortgage was forced savings. When it disappears, a large share of households absorbs that cash into lifestyle creep within 18 months. The spreadsheet also cannot measure what it feels like to watch your portfolio drop 40% in a crash while still owing a mandatory monthly payment. At rates above 7%, aggressive payoff is hard to argue against. Between 4.5% and 7%, it is a genuine judgment call. Below 4.5%, invest the difference, but only if you genuinely will. A 2019 study tracked people whose debts were fully eliminated. Anxiety dropped from 78% of participants, showing clinical symptoms down to 53%. People performed better on cognitive assessments and became measurably less impulsive. The number of debt accounts closed mattered more than the dollar amount of relief. The brain does not care about the dollar amount. It cares about the open tab. The mortgage is the last open tab. When it closes, the refrigerator you had stopped hearing finally goes quiet. Research also links high debt-to-asset ratios to measurably higher blood pressure and worse health, even after controlling for income. The mortgage is not just a financial obligation. It is a physiological one. When the mortgage disappears at year 22 instead of year 30, the monthly expense floor drops by $2,000. Eliminating $24,000 a year in mandatory costs reduces the financial independence number by $600,000. The household has not earned more. They changed what survival costs. When survival no longer requires both incomes at full capacity, people can leave jobs they hate, take pay cuts for meaningful work, or start businesses that need 18 months to become profitable. Academic research confirms that carrying a mortgage significantly reduces entrepreneurship, with the effect strongest at high loan-to-value ratios. About 40% of owner-occupied homes in the United States are now mortgage-free, an all-time high. But 63% of homeowners 65 and older are mortgage-free versus fewer than 28% of working-age homeowners. The average payoff age is 58 to 63. The median first-time buyer is now 36 years old, meaning a 30-year mortgage does not end until 66. In 1989, 3% of homeowners over 80 still had a mortgage. Today, nearly a third do. Only 23% of all Americans are completely debt-free. On a $450,000 mortgage at 6.5%, total interest over 30 years reaches $573,840. You pay more in interest than the home originally cost. Switching to bi-weekly payments creates 13 full payments per year instead of 12, cuts 5 to 6 years off the loan, and eliminates over $119,000 in interest. Adding $500 a month to the principal saves roughly $150,000 in 8 years. Adding $1,000 a month nearly halves the term to 17 years. These are not heroic sacrifices. They are the difference between paying off your home at 55 versus 63. When the last payment processes, first verify your lender filed the lien release and that you receive your deed. Lenders occasionally fail to file it, and you may discover years later that you do not legally own what you have been paying for. Then rebuild your emergency fund to 6 to 12 months of your new, lower expenses before doing anything ambitious. After that, redirect the former payment in this order. Retirement plan, match first, since that is a 50 to 100% guaranteed return, and nothing else comes close. Then, individual retirement account contributions. Then, the full retirement plan contribution limit. Then a health savings account if you are eligible. And finally, a taxable brokerage account with low-cost index funds. $2,000 a month at 8% reaches $365,000 in a decade and over $1 million in 20 years. The mortgage was not just a large bill. It was a permission slip you had to silently ask for every time you wanted to do something different with your life. Want to leave a job you hate? Check whether you can still cover the mortgage. Want to start something risky? Make sure the mortgage is safe first. It is the invisible hand shaping nearly every major decision you make. When it is gone, the grip releases. The people who stop running that Sunday night math the earliest are not the ones who earned the most. They are the ones who understood what the finish line was actually worth and ran toward it on purpose.